Good morning, everyone. It's Beyond Stocks time. My name is Chihiro Kurokawa.
And what's going on, everyone? My name is Pedro De Leon. Man, it's exciting to come back. I know many people have asked, like, "Hey, are you still in the podcast?" Yes, I am. I'm just working on the back end stuff. But today we're excited to talk about, well, not exciting, but it's kind of alarming to talk about, is private credit the next 2008? So many people have asked me in the past. We talked about this private credit thing. I know someone asked me in the past on a few episodes before. They said, "Hey, I heard something about private credit. What is that?" So, what is private credit, Shihiro? Kind of shed light on us with that.
Yeah, so it is a huge area of the financial industry, honestly, and it runs the gamut from small mom and pop shops, like
Hmm.
uh, one of our very first guests, the Rumors. They do private credit based on land, right? And so
Hmm.
they're like a small two-person shop running a lending business. And then you've got financial institutions of all sizes, from like seven figures to multiple billions, and all the way up to the largest financial institutions in the world, like Blackstone or BlackRock or any of the major uh,
Yeah.
private equity firms have significant exposure to private credit. So,
Hmm.
so it's basically in every sector of the finance industry. But what it is basically non-traditional lenders. So not Wells Fargo or Bank of America, but some financial services firm outside of the traditional lending landscape that is lending on real estate or
Hmm.
lending to businesses or really any kind of business or asset class.
Right. Absolutely. So again, most of you guys have used a loan in the past. So it's typically the same thing if you go to the bank, but you go into a private institution or private person, an individual, right, getting a loan. So that's what is private credit. Now, let's talk about the growth of private credit. So how has it grown since before 2008, 2009? I'm going to show you guys a little chart. So kind of shed light on us on that, man.
Yeah, so before the great financial crisis, so 2008, 2009, like this was like a blip in terms of how
Mhm.
much private lending volume was just out there in the system. But you see from 2005, an estimated 50 billion in volume, to the post uh, GFC era in 2010. Now we're looking at a 6x into 300 billion, which is still pretty small relative
Mhm.
to an economy that I'm guessing was probably around GDP of 20 trillion at that point in the United States. But at this point, 2025, it's estimated to hit 2.5 trillion, right? So it's
Mhm.
gone up by orders of magnitude. Um, so the so how much has it grown? Like a tremendous amount, like
Yeah.
10x, 20x,
Right.
depending on what your starting point is.
Right. What's interesting, something just popped in my mind just now. So between 2010 and 2015, I have seen several firms, mom and pop firms that became large on the lending for single family houses as flips. So that's, hard money lending. So that was part of the, I can see, can say, influence, right? Um, because many folks will not be able to get any private lending, I mean, any funding from a bank just to do these flips, right? So then that's when the kind of the private lending came upon. But so that's part of it.
Yeah, that's
And
a really good example of
yeah,
like mom and pop operators in the private credit ecosystem. That's on a small scale. Uh, I mean, still big compared to like
oh yeah,
normal people like you and I, but they
yeah.
might be lending seven figures a year. But
Mhm.
compared to a financial institution, yeah, that's on a
Yeah,
small scale.
absolutely. So what are other private, examples of private credit besides what we just talked about that comes into mind?
Yeah. So first of all, there's a lot of private credit volume lending to businesses. So
Mhm.
let's talk about like why this even exists. So in the wake of 2008, 2009, there was a lot of financial regulation that came into play in order to try to prevent 2008, 2009 from happening again, right? So there was financial reform like Dodd-Frank, for example. And so in order to prevent banks from making the kinds of pretty profligate loans that they made that led to 2008, 2009, they rightfully introduced legislation to require banks to underwrite to a higher level. But unfortunately, like what happens in capitalism is it's in some cases it's like a game of whack-a-mole, right? So, okay, you prevent banks now from making risky loans based on poor underwriting, but then other players in the financial ecosystem stepped in to take their place. So the best example I could give you is, say you have a factory, just some sort of business, right? And your business performance isn't good enough for you to be able to get a loan from Chase or Wells Fargo or Bank of America. But let's say for a slightly higher interest rate, you could get a loan and still get the capital that you need to grow your business, but it's just coming from a private lender. So it's not a household name like Wells Fargo, but you can still get access to that debt and buy the machinery that you need or buy a new facility or whatever it is that you need that money for with respect to your business. That's private credit. So somebody else just stepped into the hole that was left by banks because they could no longer play because regulations limited what they could do. So that's it in a nutshell. But in my career personally, as a multifamily operator and investor, we saw in the period, especially during and immediately post-COVID, so through about 2022, private credit stepped in to take a bigger and bigger role in debt financing of apartment complexes for people who are investing in apartment complexes. And in our industry, we refer to those as bridge loans. And they're called bridge loans because the intent of it is for it to serve as a bridge, as a temporary loan, typically 2 to 3 year term with maybe 1 or 2 1-year extension options. But any way you look at it, it's a short-term loan, right? And the point of it, the objective of it was to provide a bridge between when you acquire the loan to improve the operation so that you can then at that point qualify for what's called permanent financing through a traditional bank.
Right.
What happened in 2022 was interest rates started going up, and so a lot of borrowers ended up not being able to make that bridge, make that transition from the bridge loan to the bank lender, and then foreclosures and distress started to appear, and it's still an issue in multifamily.
Yeah, it's definitely still an issue. Yeah, absolutely. So, from the investor side, what is some of the risks of private credit? Period. Like, what should investors know?
So, with bank loans, because of the regulations involved, and also because a lot of these banks, the biggest banks are publicly traded, so there's reporting involved, right? So there's some degree of transparency in the loans that the banks have on their books, and they have some sort of accountability to report upon their portfolio, essentially. Whereas a private lender has no such obligation. So there's this opaqueness that is potentially a concern because you have looser underwriting standards and no responsibility to report to anybody. Like, you can see the risk there, right?
Yeah, absolutely.
Yeah.
It's something, it can be concerning. So again, doesn't mean like, hey, you know what, let's just put private credit out of our portfolio. Like, that doesn't mean that, right? Definitely, doing the due diligence or having someone to help you figure it out. Like, is this firm, really transparent with everything they do? So there's so many out there. It's just takes time to actually do, the due diligence on that. Now, here's one thing that besides, with the risk level. So what is some of the fallouts from this?
Yeah, and I want to make clear here, Pedro, I'm totally speculating right now. or about to
Mhm.
speculate. But I do think there's going to be distress in this sector because
Mhm.
of those risks we just talked about.
Right.
Um, People have been, and from retail investors all the way through to institutional investors have been searching for yield. And so they've been getting it in large part from high interest loans to middle market companies or shake companies, borrowers on shakier footing.
Mhm.
Uh, so I think there's going to be some sort of reckoning involved. What I don't think is necessarily going to be the case is that it will decimate Main Street and just your everyday American, as was the case in the 2008 and 9 period. Because you and I remember that period. It was rough,
Yeah.
you
Yeah.
know. That was a tough time to go through, and I think one reason that was so tough is because everyday Americans lost their homes, lost their jobs, lost capital directly in the form of losing their home, or even if they didn't realize the loss, the value of their home, the value of the equity that they had in their home went down. Whereas in
Mhm.
this case, it's largely high net worth investors that might be doing private credit on the side,
Mhm.
or high net worth or accredited investors who are investing into a private credit fund, something like that. So I think those people probably have more wherewithal to withstand some sort of downturn.
Mhm.
But again, I'm speculating here.
Yeah.
I don't know.
You know, something that popped in my mind besides on the real estate side, for investors to understand is that they are you might want to understand the type of loan that is being provided to the client. And this is really important. And the reason I'm saying this is because there are some loans out there that actually can't does it hurts the business and at the same time it hurts the actual lender. And that is one particular one that I've seen is firsthand has been the MCA loan. I'm not sure if you heard of the MCA loan, Shihiro, but it's
No, I
typically
haven't.
for business owners. But it's a shark loan. Like literally, you're getting interest at 20 to 25%, and you get charged weekly. Now, some companies are able to do MCA loans because they know that they're going to be getting like a good amount of returns within the week or two. But sometimes they don't meet that goal. And then what happens that they're going default immediately because the interest rate is so high. Now, when an investor invests in these type of loans, they are promised that they're going to get like a 20% interest rate. But what they need to understand, like what loan is that? Because sometimes it can put a company in trap. And while it puts a company in trap, then the company cannot make that payment. And then because a company can make that payment, the firm or the lender is going to go on also on default and not going to receive payments. And you as an investor, you're going to get caught up with the whole thing, right? So keep in mind, I highly recommend to ask what kind of loan are you going to be lending, you're going to be utilized or they're going to be utilizing to lend it out, so yeah. So anyways, what that also brings into this new regulation, right? 401ks, pensions, keep it in mind. So how you think is this is going to affect on people's retirement?
Yeah.
Shiro.
Um, so assuming that 401ks are going to have exposure shortly, based on
Hmm.
that executive order from, what is it, 3 weeks ago now?
Hmm.
Uh, Presumably, people's 401ks are going to have the ability to have exposure to private credit and private equity.
Hmm.
Um, yeah, listen, investing is hard, right? It's complicated.
Yeah.
There's a reason why it's generally suggested that unless you're a true professional in uh, public equities, that you should just invest passively in
Hmm.
ETFs and index funds, right? There's a reason why that's like repeated over and over and over. So if we're going to talk about introducing an opaque, more complex uh, type of investment to everyday people, there's
Hmm.
risks with that, and especially in private equity and private credit, a lack of liquidity is a big concern. And you and I talked about this previously: is the
Right.
lack
Yeah.
of liquidity, and are people going to understand that? My guess is no. People are not going to understand that
Hmm.
investing in uh, private deals generally means a lack of liquidity or
Mhm.
limitations on liquidity. Even interval funds, there's limitations on the liquidity of that kind of an
Yeah.
investment. So
Right.
how that's going to be reconciled remains to be seen, and
Mhm.
how people will. Uh, I on the one hand, yeah, I want investment types to be democratized, but on the other hand, I know that people, if given the option, will often invest in the things they don't understand.
Yeah.
So
If you don't understand, like, I don't even know where my money is going into my 401k, like, because obviously it's a 401k, but you don't know how is it invested in and what it's invested in. Definitely you can look for individuals like John Bowman. You interviewed him 2 weeks ago, right? There, he is very knowledgeable how to read and alternative investments, and he does a lot of investing in private credit. So he's to individuals like that. That's something that you want to have a chat with. Now, with
yeah,
all
I'm all
this,
about staying in your lane, man. Like,
yeah,
my
yeah.
I have a specific area of expertise, and something like what you just mentioned, I would entrust John Bowman or somebody like him, not
Right.
myself.
Yeah, exactly. Absolutely right. We don't know everything, and so, but you have those that are expert in these certain niches. So, with all that being said, do you think that private credit is going to be the next 2008?
This is nothing more than a hunch. I think not. I don't think it has the
Mhm.
capability of being that severe. Again, because of the nature of whose capital is at risk here. That's what I
Mhm.
think about. Is Main Street, is everyday Joe Schmo's capital at risk here? Um, yes, to some extent, like potentially in the form of a 401k, or if his or her pension is
Mhm.
invested heavily into private credit, then yes, that everyday American may be affected. But fundamentally, this is institutional capital. I think that is going to potentially take a hit if this
Right.
turns downward.
Yeah. So, if you're an accredited investor, been investing in several different asset classes, something that you should be aware of. Doesn't mean like, hey, don't ever invest in private credit. It's just be keep your eyes open or ears open as well, just to see what kind of investments you're going to be making into, so, and then start a little bit of economy, right? It's important to understand economics, because that's kind of will help you determine what to invest in. So, anyways, I don't think it's going to be nothing like 2008 like you mentioned, because it's not going to be hurting the average individuals, middle class, lower class, but it's going to probably end up hurting a lot of these probably family office, or um you know I know the past couple of years you probably heard of this, right? A lot of family office have been pulling the money out of some funds because it's not performing or is underperforming, whatever it is, right? So, and certain are accredited investors, right? So that's something, but I don't think it's to be alarmed about this is going to be the same in 2008. So, yeah. But anyways, is anything else that you want to share, Chihiro, before we cut this?
Well, we are looking to do a workshop
Hmm.
locally here. So, for those of you listeners in the audience who are in the Dallas Fort Worth metro, in the coming weeks, keep your eyes peeled for a workshop. We're going to have some sort of an expert in a alternative investment area to present and provide some knowledge. So
Yeah.
we'll have uh, dinner and refreshments and just a great educational session.
Yeah, absolutely. So to be in the know, please make sure we're gonna put the actual link to subscribe to our email. So opt in, and when we're gonna be launching the dates and the information, you guys gonna be the first ones to know where when is it gonna be, right? So again, this is DFW. We are looking to do it in other cities, but as of right now, we're focusing on Dallas and Fort Worth area. So all right, guys. Any questions, or any comments you want to, let us know. Chime in, and we'll do our best to respond. All right, guys. Until next time, take care.
All right.